The market is overvalued, we're due for a correction. I feel like I've heard that statement at least 1,000 times over the past decade, but sometimes corrections do actually happen. If you're an income investor, corrections are an opportunity to grow your income faster than you can during a bull market. Today we'll look at how I approach market corrections as a high-yield income investor. This market correction topic has come up a lot recently, so I'm excited to explore it. When will the market correct? The answer to this question, according to JP Morgan CEO Jamie Dimon, was a recession in the US and globally in 2023. I'm glad I didn't read this article in November 2022 and move to cash. I would have missed out on a lot of income. Let's jump a year forward. The answer to this question was, according to famous financial analyst Harry Dent, the biggest crash of our lifetime will occur in 2024. I'm glad I didn't read this article on December 21st, 2023 and move to cash. I would have missed out on a lot of income. Experts will predict an imminent correction every year, and just like a broken clock, occasionally they're correct. But the market is overvalued. Most of the time, the market is overvalued, especially the good stocks. Unless we're in the middle of a disaster and the outcome is unknown, there's no good reason for quality stocks to be attractively priced. So I ignore the crash is coming predictions and accept that occasionally the market will correct, and I have no idea when that will happen. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description. It's free. My approach to corrections applies 100% of the time, not just when the analysts say the market is overvalued, we're due for a correction. There are 3 parts to my approach. Number 1, mentally accept that a correction can happen anytime and don't complain when my portfolio goes down in value. Number 2, maintain a portfolio that delivers consistent income regardless of what the market is doing. And number 3, when a correction comes, continue to use a portion of my dividends to buy whatever is the best income opportunity for that month. During a correction, yields are higher, so each dollar invested buys more future income than normal. In other words, while the portfolio value is going down, the income is going up. For example, if I buy Main Street Capital today, it's yielding just over 7%. It's a fantastic company with a long history of dividend growth and price appreciation. But if there was a market correction that pushed the price down to the point where it was yielding 9%, like it did here in 2023, that would be a very attractive purchase. As a reminder, I'm not talking about sitting on a pile of cash and buying stocks when they're down. I'm talking about using some of my dividends every month to buy stocks regardless of whether the market is up or down. It's just that when they're down, I get more income for each dollar that I invest. Buying when the market is correcting sounds pretty obvious, but it can require some discipline. You have to overcome the fear that the slide will continue and what you buy today might be worth less tomorrow. Going back to the big picture, what's the risk to this income investing strategy? Dividend cuts. Plenty of yields are high because the investment is too risky. To reduce the risk, I choose carefully and I diversify quite a lot. The choosing part varies depending on the type of investment, so I won't cover it all here, but my in-depth reviews on the channel explain the why for buying each stock or fund that I hold. It includes things like a long history of dividends without any cuts, having sufficient dividend coverage, outperforming competitors for total return over a long period, and other factors like that. Regarding diversification though, no asset class always goes up or comes without risk. I'm just looking to avoid my income going up and down with the market. I want consistency. Each asset class for an income investor reacts differently to changes in the economy and in the market. Diversification smooths out those differences, so I'll give you some examples. QQQI is a covered call index fund currently yielding 12.8%. It would probably see a short-term increase in income if there's a correction, because the covered call option strategy generates more income when volatility is high. I'll show you what I mean. If we look at QQQI distribution history by month, the highest payout this past 12-month period was in August. That was also the month with the highest reading for the VIX Volatility Index. It's even more obvious if we look at the monthly distributions from SPYI, which is currently yielding 12%. These distribution charts came from Snowball, but I mostly use Snowball to combine my stocks from 3 brokerages into one simple dashboard. Sometimes I'm looking to sell low-yielding funds to buy higher-yielding ones, so I'll rank by yield to see how I want to rebalance my portfolio. And the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. JEPI, J-E-P-I, is yielding around half of what QQQI pays, about 6.6% as I record this, and it uses a different covered call strategy than the 2 NEOS funds that I mentioned, which were QQQI and SPYI. Because JEPI is older, we can go back to the 2022 bear market when the S&P 500 fell as much as 25%, the worst period since the pandemic. If we zoom out to distribution totals by year, look at which year paid the most for JEPI. More than $6 in 2022, it's not even close. Higher income is good news, but in the case of QQQI, it doesn't change the fact that the price would fall in line with the NASDAQ 100, which is what it's based on. JEPI has a more value-oriented portfolio and would fare better than QQQI in a correction. The downside of these covered call index funds is that if the correction continues for a long period, say 6 to 12 months, and is followed by a sharp recovery, the price of the fund won't recover as fast as its index. What about preferred shares? Well, fixed rate preferred shares will continue to pay exactly the same income regardless of what the stock market is doing. The income from floating rate preferred shares will rise and fall based on interest rates, not the stock market. A stock market correction might affect the price of preferred shares, but their income is not tied to the stock market. During a market correction, BDC prices would probably take a hit, but the dividends they pay aren't determined by what the stock market is doing. As long as the businesses they lend to pay back their loans, shareholders get paid and the yields are excellent. For example, ARCC is the largest BDC. It has a 20-year history and it yields 8.8%. This total return chart from Seeking Alpha incorporates price movement and distributions. Over the past 20 years, ARCC has easily outperformed the S&P 500. These total return charts are important for income investors because they tell the whole story, not just changes in price. Seeking Alpha is also great for analysis. This article by Patient Tech Investor is an analysis of the effect of further rate cuts on ARCC. I'll put a link in the description to that article and a link for Seeking Alpha to get a discount on the membership and a free trial. I use it every day. Now, of course, if there was a major recession and the economy came to a standstill, BDCs would be at risk like most asset classes. But I want to differentiate between the economy and the market. The economy looks to be in pretty decent shape at the moment. I'm addressing concerns that the stock market is overvalued and what would happen to the dividends if the market goes through a correction. We don't have time to break down every income asset class in this video, but some of the others include corporate bonds, collateralized loan obligations, which I covered in this video, Bitcoin. I don't mean actual Bitcoin, but using futures and options to generate income from Bitcoin, which I covered in this video. Some of the 30+ stocks and funds in my portfolio could see dividend reductions in a bear market, but I don't expect the total income to change much. The most volatile income by far would be a Bitcoin fund, but my allocation to that is quite small, currently 2%. So that's what works for me. If you can't sleep when your portfolio drops 20%, then maybe you're more comfortable leaning towards short-term treasuries that pay 4%, or AAA-rated CLO funds like JAAA that's currently yielding just over 6%, or maybe a REIT like Vici, VICI, that's currently yielding just under 6%. I don't currently hold any of those. The closest I have currently to that type of investment would be JBBB, and that's yielding just over 7.5%. If you're tempted to sit on cash, then you're trying to time the market, technically. Now, if that helps you sleep better, that's fine, but I do suggest reading studies of timing the market versus dollar cost averaging. Market timing seems easy when you look back in time at a price chart and think, I'll just buy the dip. But when you're actually in the moment and the future is unknown, it is a bit harder. I can sum this up with two diagrams about market timing. Number one is the expectation, and number two is the reality. If you want to time the market, I suggest reading studies that compare it to dollar cost averaging. Here's an example. The finding was that if you can time the market perfectly, you'll make slightly more than dollar cost averaging. If you time the market poorly, you'll make slightly less than dollar cost averaging, but at least you'll be in the market. And the worst decision, by a long way, is to just sit on cash for the long term. This video started as a 5-question Q&A, and it turned into a deeper dive on one question. We'll get back to doing regular Q&A style videos soon. If you haven't seen any of those, there are currently 5 uploaded to the channel as I record this, and you can watch them by clicking here. That wraps it up for this look at income investing during a market correction. More Armchair Income coming soon. Armchair Income, that's my hustle.